Hard.
Well, thank you for the invitation. This is my first Twitter space, so I'm glad I managed to go and miraculously join. So I'm basically corporate Wall Street for 35 years. I was at Merrill Lynch for 26 of those. Part of that time, I ran mortgage trading, derivative trading, option trading, all the fun stuff. I was at PIMCO for a while, and now I've joined Simplify Asset Management. I go by the moniker the Convexity Maven because everything I do revolves around convexity, which is simply unbalanced leverage. You could make more than you could lose, or vice versa. It's not an even one-to-one bet when you get involved in securities or any other kind of investment process. At Simplify, what is truly unique is we buy the option. We buy convexity. So we give you your ordinary beta, but then we add in convexity, where you can amplify your gains or cushion your losses. This is extraordinarily unique because my experience of 35 years of this field is that everyone wants to go and sell optionality, sell convexity, sell the risk, so they could take the yield up front. Right, when you buy a junk bond, you're selling a CDS, a default swap, plus a Treasury. So you're selling the option. If you sell a call option for a covered call, you're selling the option. People like to get the income or the money up front. It makes them feel good. But of course, when you sell an option, you have limited gain and unlimited loss, which I would define as not a career enhancing profile. And I've spent most of my career being long optionality, long convexity. And I'll say up front, I have a website, convexitymaven.com. I publish a free commentary, a macro commentary every, 4 to 6 weeks. If you have an interest in being subscribing, just send me an email at harley@bassman.net.
So I've heard a lot of your prior interviews and podcasts, Harley, and one of the things that resonates very well with me is your focus on the path, right? That everything is largely path dependent. I want you to talk about that aspect of markets for a moment, because I think too many people on FinTwit focus more on the endpoints rather than the way that you get to the endpoint. I'd argue that the path always matters more than the prediction. But how does path behavior when it comes to various asset classes impact one's ability to not only stick to a strategy but also benefit from those tails when they occur?
Michael, I will say that is an extraordinarily insightful comment. That's exactly right. So if you think about the world, you have various risk factors. And so if you buy a stock at 100, goes to 110, goes to 95, ends up 105, you make 5 points. You have a bond that goes up, goes down, ends up somewhere else, you make your money. In options, it depends how you get there. It is a path dependent activity. And people don't appreciate that because people may be good at looking at where something's going to be tomorrow, but how we get there is different. And that's why options are a very different animal. And why convexity, I would define the three main risks as duration, so when you get your money back, credit, if you get your money back, convexity, how you get it back. And convexity is not an intuitive concept for most people, which is why it's so difficult, and people get kind of rattled by that. As far as the path dependency option concept and why it's so important, and why the simplified products, I don't want to push them too hard here, but why they're interesting is that the real debacle of March 2020 was that people, if you just held the entire time, you did fine, but you didn't. Most people got scared and they sold and they never got back in. And so having a convexity, positive convexity in your pocket often allows you to go and ride out, a bumpy road. We are social animals. We like to be with crowds. We like to have the feedback of crowds. That's why when you go to the bar or go to the game or wherever else, and the market's going up, and everyone's bragging how they're long, and you go, I want to be long also to be part of the crowd. And that's why it's so euphoric at the top. And I'll tell you, even for me, when we're at the top, it feels great, man. And at the bottom, it's the same. I'm crying. I'm under my desk. I want my mommy. And if I'm long a put option or long some kind of convex profile, it allows me not to panic. And so that's the value of having convexity. And this is where leverage comes in. People, if they get over levered, When the markets go down, they can't ride the trade all the way through because they're forced into a stop out. So that's kind of the gig there.
And again, for the audience's own education, explain the link between convexity and the tails in the distribution, right? Because these are two words that people often say together, maybe not understanding that you need one for the other.
Let's just dumb down convexity, okay, for mom and dad. Here's what it is. Okay, don't get caught up in the Greeks, the deltas, the gammas, all that crap. If you are invested or you have a profile where for equal up and down changes, you make a dollar or lose a dollar, that's zero convexity. If you make two and lose one, that's positive convexity. If you lose three and make two, negative convexity. Full stop. That's it. Now, the magic and why we were hiring all these physics PhDs in the 90s is that if if you should get a 5% yield for a up one, down one bet, if you have an up two, down one, well, that's a better bet. That's a better investment. That's a better trade. Well, you shouldn't get 5% for that. You should get 4% or maybe 375 or four and a quarter. What's the right answer? Well, that's where the money, magic physics of money comes in. And if you could lose three, make two, well, you better get paid more for that. Once again, this is where the magic comes in. People are not intuitively good at figuring this out. And this is because people place way too much emphasis on scary things and not enough on more rational things. So, for instance, there's people who are scared to go swimming in the ocean because they're afraid of sharks, or they're afraid of lightning, might strike them on the golf course, and they're frightened of these things and they act in a certain way. This is kind of silly. No one gets bitten by a shark. Well, I guess a few guys do, but no one gets bitten by a shark, and no one gets struck by lightning, okay? But how many of you, when you get in a taxi, don't put on your seatbelt? Okay? That's the kind of thing, is that people are not really good at evaluating real risk in terms of how bad it might be and how often it might occur. And this is where people get over their skis very often, and they'll take on too much risk and get hurt.
And that kind of relates to this other point I've made many times on prior spaces and in a lot of my own content, that people get too caught up in frequency of gains as opposed to magnitude. When you're playing with convexity, you're playing for magnitude, not so much frequency, because it's not like you constantly have convex moments to take advantage of. But when they occur in a spectacular way.
You know, that almost sounds like you're down like this GameStop idea where options are used to go and capture huge wins. You don't have to go and have huge wins. All you have to do is just minimize big losses to the extent that what do they say? If you go and you get rid of the top 10 up days in the year, you kind of give away the entire year's income. People very often get shaken out. And so if you can just avoid that, you're probably going to do okay. I close almost all my commentaries with the advice. Sizing is more important than entry level. I rarely get hung up on trying to buy the bottom or sell the top, because frankly, I'm not going to do it. If I ever buy the bottom, it's because I meant to sell and hit the wrong button. It just doesn't happen. I want to go and size a trade such that if I'm right, it makes a difference, and if I'm wrong, I don't go bankrupt. And I think if people go and try to play for a longer horizon over time, power of compounding, they're going to win. I really do not like people getting hung up on short-term investing, unless you're a professional, I suppose, or swinging for home runs. It's just unlikely to happen. I think the tortoise and hare. I think the tortoise tends to win more often than not.
I'm glad you mentioned that 10 worst days, because everyone always cites that as a example of why buy and hold works, because you don't know when the 10 days occur. But it's remarkable to me that nobody ever goes a little bit further in that analysis. When you look at the 10 best days and 10 worst days over any time period, you see that they often cluster together. Right? In other words, big extreme downs tend to be followed by big extreme ups. So it turns out if you take out the 10 best days and 10 worst days, you basically get buy and hold performance with a lot less risk, right? You're kind of the volatility aspect of market dynamics. Now, that lends itself to a discussion around volatility beyond what people think about with the VIX. So you created the MOVE index. I know you've answered these kind of questions ad nauseum, but I want to set the stage for the audience. Talk about what the MOVE index is, how you came up with it, and why it's important, or perhaps more important, to look at than the often cited VIX index for equities.
Well, I did create the move a number of years ago, and I will tell you that for the first 15, 20 years, I couldn't give it away. I mean, I was speaking to the
It was
journal
immovable, you
investors.
could say, right?
As a matter of fact, it almost got shut down when Bank of America bought Merrill Lynch, and I had to fight and scratch a claw to keep it alive. Bank of America sold it to ICE, and now it's very popular. So I guess it's matters. And by the way, when they sold it, I didn't get a penny. So I guess too bad. The move index is very, very simple. It's a number, and it is the blend of the implied volatility for a 1 year for a 1 month option on the 2 year, 5 year, 10 year, 30 year, weighted 20, 20, 40, 20. That's it. And if you take that number, because it's not an index per se, it's a real number, and you divide that number by 16, actually 15.9, but let's call it 16, um, that tells you how much what the option market is implying the market will move every day. And so right now the move's at 113, divide that by 16, and you get 7-ish. And that's kind of what the market is saying. The break even for options is the market moving every day 7 basis points, and we've been moving about that every day. So the market's kind of right. Um, so it's similar to the VIX. The VIX, by the way, is similar. It's kind of a 1 month option on the S&P. It's a little different that it's not, and this is if you're a geek, this is important. If you're not a geek, just forget this next section over here. The VIX is not the implied vol of an at-the-money option, which is what the move is. It's actually a blend of all the options up and down. The at-the-money, 10% down, 20, 30, 40%, it's the whole string of them. And that's why the VIX, because there's a smile, there's a skew, and skew just means the difference in implied vol for an at-the-money option versus an out-of-the-money option. Nothing more, nothing less. Because there's a smile to it, where the out of the monies tend to be higher than the at the monies, the VIX tends to be, 2 or 3 points above the at the money option. But it's the same concept. You can't buy the VIX and you can't buy the move. When you trade the VIX, you're via various instruments, you are not buying the VIX. You are buying futures contracts on the VIX. You actually can't buy the VIX. So just to be clear about that, people have been asking me for decades to trade the move. Can't trade the move. If there were move futures, I guess I could do it, but that's never going to happen. Right. Interestingly enough, you're seeing the spread of the VIX over at the money options has expanded from 2.3 to 3.4. And the reason for that is out of the money calls are now skewing up also. It used to be a 10% out of the money call would be lower than an at the money, but now they go up because people are scared of market moving both ways. So the VIX is a little more exaggerated, but not by much. But that's the two of them do. Going one step further, which you didn't ask, but I'll say anyways, these two indices, as well as implied volatility for almost any liquid instrument, gold, commodities, lumber, all that stuff, tends to be the implied option, implied vol, is about 8 to 12% over the realized volatility. That's it. So everyone saw all these charts for the last 3, 4, 5 months of the move exploding up to 140, 150. Well, the VIX was kind of stopping out around 130, 32, 33. And they're saying, why is that? You look at the chart and the VIX, the move is massively higher, relatively. And the reason why is rates were moving. We had 10, 15-point days of interest rate changes, whereas the S&P really has not moved that much. Even when we drew down by 20, 22%, it was a very orderly decline. And so you'll tend to see implied vol basically track realized. Now, what's interesting right now is both the VIX and the move are trading well under the most recent realized vol. So the move right now is 113, which is basically 7 basis points a day. Whereas looking backwards, the realized vol is 137, 8.5 a day. So the market's basically kind of saying we're going to slow down. We're still moving. Seven a day is a lot, but you now have implied vols under realized. The VIX at 20, which means the actual options are probably around 16, 17, and realized vol for the SPOOs about the world.
I just apologize for not knowing this, but what's the inception date on the index? How far back does it go?
I invented. We started the move in 1994, but actually we had data going back because I was running that business at the time. So I had the data going back to 1988. So in actuality, the move actually goes back further than the VIX, and so we've data to just after the '87 crash. And well, if you actually pull up the move and look at it over the last 30, 40 years, what's kind of interesting is that for the first 20, 25 years, it went up and down around 100, 6 basis points a day, right? 100 divided by 16, six basis points a day. And if it got to 80, you buy it. You got to 120, you sell it. Now, I will tell you that whenever it got to 120, nobody sold it. They were all crying for mommy because it was just too volatile. But you're supposed to sell the same way the VIX gets to 40, you're supposed to sell that. But I got to show you, VIX at 40, no one's selling options. In the last decade, the range has really been like 60 to 100, as the Fed has basically intentionally reduced volatility. That was part of the master plan after the great financial crisis, was to really go and reduce volatility to encourage risk taking. So it's not some weird result. It was actually part of the master plan of buying mortgages. It was in the same way. It's a massive risk reducer because a mortgage is a negatively convex bond. So when they buy mortgages, they're effectively selling billions and billions of options into the market.
Yeah, no. The reason I ask as far as how far back it goes is if there a way to backcast it to see how it would have looked in the '70s, right? Which obviously is not exactly easy to do, but this issue of volatility in rates being larger than the volatility in equities this year, I'm going to make the assumption is a fairly rare occurrence, right? In other words, the volatility of the move index itself is probably over time a lot less than the volatility of the VIX itself, kind of the VVIX, derivative.
Whenever you do a relative comparison, anyone that took Stat 101 knows that you can prove anything. I mean, every politician does the same nonsense, man. One guy quotes average, one guy quotes median, and you get different answers. It's kind of like what you got. You have the town of 10 people, and there's, 9 of them making 1,000 a year, and one guy making 1 million a year. So everyone's making 100,000 on average. No, they're not. Okay, there's one guy making it all. So you can say the mean's 100,000, or the average is whatever. So it's the same thing with comparing the VIX to the move. The guys who showed that chart, and I love the chart. I love the chart because it gets everyone talking about the move. Move's my baby. So all PR is good PR, despite the fact it's disingenuous sometimes. They started that chart when the move's starting at 40, which is incredibly anomalous. I mean, 40, 45, 50. I mean, these are numbers unheard of in the history of the move. And the reason why it was there is that you had basically 40% of the market at zero. There was no vol for the 2-year. The Fed had rates pinned at 12 cents, 12 basis points, and they had given forward guidance a year and change ago saying rates aren't moving until the beginning of 2023. So twos were trading at I don't know, 15 cents, 20 cents. Fives, same kind of thing. They weren't moving either. So when you take most of the 40% of the move, put that at zero, and then you put in 60 or 70s for the 10s and 30s, you get a 45 move. Once the Fed released the front end and said, guys, remember what we said about 2023? Forget that part. We're going to take rates up. Don't know how far. I'll tell you when we get there. Well, the 2-year explodes in vol from basically, a realized vol of 20 or 30 to a realized vol of 160. That's why the move jumped so much. If you compared the move or the implied vol for only the 10-year rate versus SPOOs, S&P, sorry, guys. SPOOs is the lingo we use because that's the futures contract, SP and Z, so we say SPOOs. It's the S&P, SPY. If you compare those two, the chart would not nearly be as interesting because the vol of 10s never got that low, And on the way up, the volatility has never got that high. We've been led by the front end, up and down. And so that creates this kind of anomalous chart if you start from, November, December of last year. I mean, look, the move's up a lot. I'm not saying it's not, but I mean, it's a bit chicanery when you start it on December of last year. If you start the move from 5 years ago, the chart looks kind of blah.
Yeah, no, that makes sense to me intuitively. And I'm curious, Harley, have you ever done any studies to see if there's a let's call it a spillover of move extremes to equities or other parts of the investable landscape? This idea that if you have extreme volatility in bonds, there's some kind of lagged effect on other parts of the investment equation.
The answer is a hearty yes, and with the warning, don't do this, you'll get hurt. As I said before, there are three risks: duration, credit, convexity. Duration is measured by the shape of the yield curve. So if you get like a 2% rate for the 2-year and a 4% rate for the 30-year, it's an extra 2 points of yield you're getting for taking the risk of duration. So shape of the curve is a risk vector. Yield spreads, if you're talking if Apple trades, 20 over or 100 basis points over, junk bonds trade, 300 over or 800 over. That's a risk spread that you get for taking on, exposure to credit. And, convexity, path dependency, optionality, VIX at 15 versus VIX at 30, move at 60 versus VIX at 100. Those all tend to move together. You will see usually the yield curve steepen, and you'll see credit spreads widen, and you'll see vols go up, the VIX go up all at the same time. The problem is there's a lead lag. I'm sure you'll love this. There's a lead lag to it, which is extraordinarily unpredictable and wide and long enough such that you will not make any money doing it. But if you had a supercomputer that was managing a giant pool of money and said, I'm going to put my money into where I can get the best return, the best bet, you would see it going between straight duration, so trading treasuries, credit, so junk bonds or high grade, optionality, selling vol or buying vol. It would go back and forth between those three risks as each risk compressed. If you go to my website and look at any of my commentaries, probably every other commentary will have my favorite chart, which is the yield curve versus implied vol. And for implied vol, I'll use like the 1-year option on the 10-year rate. And those go beautifully up and down together over time. This makes perfect fundamental, not technical, fundamental sense because as the yield curve takes on shape, steep or inverted, the steeper or more inverted it gets, the more uncertainty you have. And thus implied vol should rise because implied vol is the price of uncertainty. And so right now, we have a very inverted yield curve, and thus, theory vol should be rising, like if they're high right now. An inverted yield curve tells you, like, hey man, the bell's ringing, something's wrong over here. And usually when you get an inverted curve, you get a recession in 14, 16 months. There are people arguing that we're in one right now, and maybe we are. But I mean, the inverted curve at this stage of the cycle is extraordinarily anomalous. Extraordinarily anomalous. Usually the curve will invert at the second to last Fed hike. Here, it basically inverted before the first one, which is why everything's kind of crazy right now because we kind of can't figure out what's going to go on. But as this curve inverts more, that implies more uncertainty and greater risk. And a curve inverting like this at this point in the cycle is kind of telling you we're going into a depression, man. Do I think that? No, I don't. But the bond market is waving a big red flag, which you can't ignore.
Right, and I'm glad you mentioned because this is where there's a lot of nuance to even the way the bond market, in particular Treasuries, behaved this year. Which is okay. So you've got the inversion, you've got recession, maybe even sort of a depression type of signal, given the way it's behaving. But you don't really have spreads blowing out in a major way, which is sort of the classic risk off dynamic where there's volatility in equities, spreads blow out, and money goes into the quote unquote safety of U.S. government debt. So, which is more classic risk off, right? You haven't seen any of that. That's been, to your point, wildly.
Sure we did. Sure we did. Look at high yield. They went from what, two and change to what, six and change? That's a huge move
Yeah, no, no,
in junk bond spreads.
but it wasn't at the start of the year, right? It was a delayed response, right? It was,
Yeah.
I think, in the right, which the first several months of this year was really a shift in the yield curve. It wasn't the classic reason for yields rising, which is default premiums increasing.
Yep. So yeah, look, this is a normal. I mean, someone's going to be right over here. The stock market, the bond market are kind of having a head-on collision over here. I think part of it has to do with this. People. The technical idea of a recession is back-to-back quarters of negative GDP, negative real GDP. Now, as we know, we have to have the NBR go and opine upon this, usually a year after it's already happened. And so they'll tell us later. Do we really just have a recession, or are we in a recession because we've had negative back-to-back? Oh, I don't buy into that. And the reason why I don't is that this real GDP of -1 is happening as we have a positive nominal of 7 and an inflation of 8. I mean, we really haven't had that in 40 years. When you have, nominal of 3 and inflation of 2, okay, fine. I mean, I can live with that, because inflation doesn't really exist. So the nominal and the real are the same number. Getting a -1 with a nominal of 7, I mean, that's a huge number. GDP has grown by a lot, in the last year, nominal GDP. I guess you could buy, fewer loaves of bread with your salary. So I suppose that's bad. But I mean, calling it a recession is, I don't know, a distinction without a difference. It's challenging for me. I mean, I'm a believer. It's never different this time. But this is challenging.
But it's a little different. That's right.
It seems that way now, but maybe when the whole thing is said and done, it won't be. I mean, I'll tell you this: we have not invented tragedy. Okay, look, right now, everyone thinks this is the worst time in the world, and our politics and it's insane, this and that, and blah blah blah. 1968, we had 2 assassinations. We had bombings going on by internal terrorist groups. 68 was vastly worse than right now, despite the fact that it feels pretty bad right now. When we start getting people assassinated, they call me and say it's worse.
So I went back and forth, Harley, on the what I should name this Twitter space, and I kept hearing you in conversations talk about hubris. That hubris is what destroys mankind, which is a really nice dramatic way of framing, I think, today's discussion. Now, I'm part of my own ethos is this idea that nobody can predict the future. I can't predict it better than anybody else. Nobody can. The only way you can argue you can predict the future is that old saying that best way to predict the future is to create it, which I think is what everyone believes the Fed can do. The problem is if the Fed can't create the future, or in the process of creating new futures, creates futures they couldn't ever see, like the one we have now, it creates problems. So I want you to talk about the intersection of Fed overconfidence about their ability to control things and investor delusion in thinking that they can.
Well, first off, I mean, everyone's always yelling at the Fed and calling them a bunch of idiots for whatever variety of reasons. I don't buy that. I mean, everyone acts rationally from their own point of view. Um, the serial killer is caught. They take him into the police station. They give him his coffee and donuts, read him his rights. They say, "Mr. Serial Killer, why'd you kill the family?" And he says, "Well, the voices told me to. What would you have done?" He thinks he's doing the right thing. The Fed has a set of facts in front of them, and they have a set of goals. And those goals may be different than our goals. The facts are probably the same, usually, um, but the goals may be well different. And so, where I'm talking about hubris over here, remember, we still read the Greek tragedies, we still read Shakespeare, thousands of years, hundreds of years later, because these writers captured, the frailty of mankind, which is hubris, ego. If you look at our politics right now, I mean, what am I going to say? I mean, it's all about egos of the various players on both sides. What is Powell looking at here? He's looking at inflation that's gotten out of control. Why did it get out of control? What I think is that he was supposed to be nominated earlier. He wasn't. They nominated him late. They confirmed him late, and he wanted the job So therefore, he really couldn't start hiking last year when he should have, because if he had started hiking, he probably would have gotten confirmed by one side or the other. He probably would have been replaced by a more liberal person. So he waits. And now the toothpaste is out of the tube, and we have the inflation, not a tremendous shock. Um, and he's saying, okay, Arthur Burns, not thought of fondly. Volcker, folklore hero. Who do I care to be? Now, people will throw around saying Volcker did not do anything. It was just demographics, which I tend to agree with, by the way. They'll say Arthur Burns tried but failed, didn't try hard enough. That may be true. But nonetheless, when they write the history books, you don't hear good things about Burns and you hear great things about Volcker, whether it's true or not. What do you think Powell would rather be when they write his obituary? It ain't going to be, Powell copies Arthur Burns, lets inflation run away. It'll be modern day Volcker saves economy. That's what he wants, and he's going to go and do it. That's it. I'm not thinking so hard about the facts or anything else. And so therefore, he's going to go and slay inflation. And is he going to go about the wrong way? Maybe. I mean, to some degree, the Fed has a couple tools, and that's it. And therefore, they're reduced to slicing bread with a chainsaw. I mean, they can't impact supply, so it's got to be demand. How do you impact demand? You cause a recession. I mean, and people lose their jobs and they can't buy any more bread. Is that good or bad? Well, if you're the guy getting fired, it's not good. But right now, if you look at, and I'm stealing now from my last commentary, the bottom quintile, lower 20%, caps out at $27,000 a year income. The top 20%, 141. So 60% of people make between 27 and 141,000. These are the people who are going to get hurt by inflation. The rich guys don't care, and the poor people have, various government programs. So you have 60% of the country is getting hurt by inflation. If they take unemployment from 3.5 to 4.5 or 5.5, well, that's 2% of the people. And I feel bad for them, but if you balance things out, you're supposed to cause a recession and take unemployment up. And so I have no problem with doing it. I hope I'm not fired from my job, I suppose. But I mean, that's what's going to happen here. And I have to think a whole lot harder about things than that. And inflation is not coming down. You can take inflation to zero for the next 6 months, and we're still going to have a 4 or 5 print at the end of the year. So it doesn't matter what you do, and it ain't going to be zero. Maybe we'll have gas prices down a little bit. Maybe they'll go up or not. Once we get done draining the SPR. But I don't see wages get loosening up. Housing definitely is going to keep on going. I mean, OER, I'm sure you spoke about this on your past podcast. I won't go into detail, but OER lags housing prices by 6 to 9 months. So that's going to keep on going. And the various input prices for other stuff is not going to, be going down. So I think inflation is here easily, next 12 months. So the Fed cutting rates next year, which the futures market is kind of pricing in, ain't going to happen, man. I'm sorry. It's just not going to happen. Oh, yeah. Oh, thank you. Yes, Mike and I are good personal friends as well as professional friends from many years ago. When I was on the sell side, he was on the buy side. And he and I tangle a lot. I think what's important to think about here, which is the hard part, is we used to have a relationship between inflation and interest rates. And those are great charts going back. I think what's happening now is that relationship is breaking down. I'm not quite sure why it is, but it is. And I think the Fed is probably happy with that. I think they would like to have a negative real rate. I think they'd be happy with inflation at, not too happy, but reasonably happy with inflation at 4 or 5, even though they say they want it at 2. And bonds at 2, 3. I think they love that because basically it allows them to go pull inflation down from 8, 9 to 4, 5, 3, 4, 5. But a negative real rate is very good for stocks, right? I mean, if you're a business, you can borrow money at negative real. And I'll tell you that if they can keep rates, not inflation, rates down, but inflation high, that's good. That's a great public policy outcome. Stock prices will go up when you have inflation initially, because what is inflation? Higher prices means higher revenues. So clearly the E is going up for a PE ratio. Usually what you see is the PE go down as rates rise, rates aren't rising. I mean, they're up a little bit, I suppose, but I mean, really, what 275 in the 10-year is a big number? I don't think so. Um, so I think they would be very happy with that as a number. Mike and I are tangling. I mean, with the whole transitory nonsense from last year. Um, it's really, where do you want to hang your hat? I find it hard. I think we have inflation, okay, and that's it. I don't feel good saying where rates are going to be, and he does, and he could be right. Um, I think it'll be hard to get rates above 4. I think that'll be tough. But could they get there? Yeah, they could.
But I want to hit on the negative real rate point for a moment, because that is the argument, right? Negative real rates are great for a highly indebted nation because you can eat away at the debt. Of course, the problem with that assumption is it assumes that politicians won't add on more debt that the negative real rates would eat away, right? So I do wonder if the argument is that you're still going to have inflation higher than your interest rate, and that you'll still have negative real rates. If at some point that does become a negative for equities, because at some point maybe equities start questioning whether the U.S. government or any government can really ever pay off its finances without MMT.
Um, the nexus of that question is the correlation of stocks to bonds. Now, for the last 20 years, you've had stocks to bonds going in inverse directions. So stocks up, bonds down, vice versa. It's I guess a negative correlation by price, or a positive correlation of stock price to bond yield, which is how we have to actually functionally do it. There is, I won't call it evidence, I'll call it really, really good looking charts by lots of people that show that when you get inflation above 2, 3, rates above 3, 4, that correlation flips. So presently, and the reason why 60/40 has worked so well for the last 2 decades is that when stock prices go up, bond prices go down, so you're hedged. So you could reduce the volatility of your portfolio. That's a good thing. If you get the correlation to flip, so where stocks and bonds go up and down together, this is really bad. And we've seen this happen twice. We saw it happen in March 2020, saw it happen in November of 2018. Both times the Fed came to the rescue, because when that happens, stocks and bonds move together in unison. Levered money implodes and things get really ugly. Will it happen again? Well, I'll tell you one thing is, if you look at the last, X number of months, stocks and bonds are moving kind of in tandem. And the relationship, we use long moving averages for these, so they haven't turned up totally, but they've moved off the bottom. And when you think about it, why do these big tech companies, why do they move like bonds? I mean, I call these companies basically 70-year duration treasuries. That's what I think of them. You look at Amazon or Apple or Tesla, let's agree they're going to make $1 trillion in 30 years. I'm not going to fight that. They're going to make $1 trillion. Question is, what's $1 trillion in 30 years worth today? That's where the rate comes in, and that's where the PE comes in. And so we did get rates up enough that would be, well, I won't call it curtains for finance, but it would not be pretty, which is why I own various products for interest rate protection, not because I'm so bearish on rates, but because if they go up above 3.5, 4, it's not going to be pretty. When you buy life insurance, you don't win when you die. When you buy car insurance, you don't try to crash your car. You should be buying rate insurance because it's really cheap right now, just in case we do get higher rates, because inflation just can't be contained.
Yeah, although I guess the question is then, if rates do that, then maybe there's more insurance payout by betting on tail event and equities, right? Because presumably that would have a lot more movement, right, in the extreme on the spillover of that.
Yes and no. Yes, I mean, there would be a bigger payout, but the price is vastly higher. If you look at
Sure.
the cost of short-dated tail options on equities versus the cost of 6, 7-year options on interest rates, there's a vast difference in pricing. If you think the market will crash tomorrow, yes, go buy some out-of-the-money puts on SPOOs. If you want to buy a 5-year protection on S&P, That's ridiculous. The cost would be insane. But if you could buy it on rates protection, that's extraordinarily expensive, which is an entirely different idea. You go to my website and go read all about it. I've explained it in detail there. You're circling around the drain of forward pricing because we're saying we're going to look at the Eurodollar curve or the Fed funds futures curve and say, okay, there's a kink sometime between December of this year, March of next year, and December the following year. So the market's looking for a 50 basis point cut. Let's call it from March of next year to December of next year. I suppose you could say that looks true, and it is true if you put the spread on. But remember, where do these prices come from? They come from the spot curve. The forwards are not a prediction. Forward rates are the number crunch of the back end of the spot curve. So the real question is not, are we pricing in a Fed rate cut next year, but why do we have an inversion between the 2-year and the 5-year that's so huge? What's driving people to go and put that trade on? Because that's how these things happen. If you go back and look at like Liar's Poker and the old Solomon Arb desk, they made their money on trading the difference between the cash 2-year and the cash 5-year versus the futures contracts and the forwards, which as a professional you can do, as a civilian you cannot. And so what you're really saying in writ large is, why the hell's the 10-year rate, 50 cents under the 2-year rate? That's the bigger question, not the micro of rate cuts next year. And I suppose it's, the bond market says we're going to head on into a recession, and it's going to be a panic. Do I believe that? No, I don't. But prices are prices, and that's where they are. Two comments on that. Number one is a 7% nominal GDP a recession? I have a hard time swallowing that. More importantly, although Mike and I love to tussle about transitory and everything else, where we agree completely is that demographics is everything. Did Volcker help or hurt what he did? Yeah, maybe. But the reality was this. 1970s was all about the baby boom generation entering the workforce. Okay, they're this massive bulge, and they're getting married, they're buying houses, they're demanding cars and washing machines and everything else, and they're buying it from a World War II generation that's much smaller for a lot of reasons. The Depression and war killed people. And that was really drove up. And there's some great charts that show interest rate, inflation versus labor force growth rate. And that is the number one chart for everything, I think. And it came down for 40 years as, this pig in the python of the boomers has gone on through. It's possible the explanation for what's happening is this. We are seeing the grinding of the gears of the baby boom generation leaving. They're retiring now. We're not fully retired. We're only halfway through them turning 65, but they're retiring. I think this great, disappearance of the workforce, just the boomers saying, hey, man, I made an awful lot of money in the last 10 years over here. I think I'm going to call it quits and not come back to work. And I think, we're losing these workers, these skilled workers, and the millennials. Millennials are actually bigger than the boomers by number. They're smaller relative to the population size at the time. And these millennials, they get married 4, 5, 6 years later. They have kids later. The average age of a kid in New York, first child is 31. In San Fran is 32. My oldest daughter is 33, and I keep begging her for grandkids. I think what we're seeing here is this kind of grinding of those millennials coming in, demanding stuff, boomers leaving, and we can't kind of figure out how to do this. And the boomers naturally should be selling stock and buying bonds. And you get bonds up to 3 and change. When things were at the bottom a month and a half ago, I was buying AA California 4% coupon bonds at 99. In my bracket, that's like what, 8.5%? Those are equity returns, man, right? I mean, why wouldn't the boomers be loading up muni bonds, or other fixed income assets when rates had risen? That by itself might be the demand. You had the defined benefit pension plans, which had basically finally got their heads above water for the first time in 40 years. Heck, man, sell stock, buy bond, lock it in, go home, go play golf. So, I mean, the demand for the back end might well have been purely demographic, as opposed to a vote on inflation. And the unemployment rate of 3.5, that's very likely because participation is going down because boomers are retiring, and they'll keep retiring. Now, I will tell you this: that the grand problem for the next 10 years, 15 years, is how do we process the boomers? I think the boomers are the pig in the python. I think as a class, we have stolen from our children, which is abominable. It's a public policy disaster. But boomers vote and millennials don't. And, how we're going to go and fund Social Security and Medicare is beyond me. That is the public policy, conundrum for the next 15 years. Well, I'll tell you that I put on that trade in a different way. I went and bought 10-year puts, and you can go look this. I've written about this trade numerous times on my website. 10-year puts on dollar yen, and this is when it was trading at I don't know 90 or 100 like some years ago. It's trading at 107 just last year. I mean, if you think about it, you have a balloon, you yank it underwater, and some part of it is going to get through your little fingers and pop on out. When you have this, controlled economy in Japan, you've seen. I guess you won if you actually you shorted Japanese rates in yen and didn't hedge it out, then you won, right? The currency collapsed. So, I mean, if you look at the whole construct, the trade has worked. You didn't make it on the rate; you made it on the currency. One would argue the same thing with the U.S. Is it's the Fed, does this, then the currency moves. I mean, something has to give. The currency or the rate has to give, and so the trade did work. Japan is people have always said that a central bank cannot create inflation. That is totally false. Of course they can create inflation. Look at Japan, man. They create inflation. They collapse their currency. It's just a matter of how hard you want to try. I mean, I'll give you guys a heads up. I'm starting to map out my next commentary, and it really is about this entire notion over here of the Fed. The Fed did create inflation. It's created it in assets and stocks and bonds and art and gold and everything else. We got inflation. It's easy to create inflation for a central bank if you want to call inflation 8, 9, 10%. It's really hard to get 2% inflation. That's threading the needle. Landing a jumbo jet on an aircraft carrier. 8% inflation is easy. Look all the countries that blow themselves up all the time. Can the Fed do the soft landing? Maybe. I don't think so, but maybe. But I mean, Japan basically, their master plan was to go and create inflation, and they have. They did it by killing the currency. So I mean, the trade worked. Well, I mean, part of what you're kind of zeroing around over here is the fact that there's the Treasury cash curve and there's the swaps curve, and 2-year swaps trade 30 odd basis points above Treasuries, whereas Treasuries, whereas 30 years trade 30 basis points under. So you have a 60 basis point spread between 2s, 30s, and swaps versus Treasuries. Eurodollars priced off LIBOR, off of swaps, whereas Fed fund futures price off Treasuries of sorts. So you get this kind of, I don't know, weird apples and oranges kind of dynamic going on. Should you put on a fly? I suppose you could maybe, but I mean, that's a challenge. We just don't know where the Fed's going to take this front end up to. I mean, there's a story to be made where the market's looking at cutting rates next year, and I think we're going to a 4 handle, just because I don't see inflation lightening up, and I don't see Powell, giving away his his obituary to someone else. Two's a 3.25. I mean, you really can't cry about that, man. It's a reasonable return for a rock solid safe investment. Um, uh,
Well, and to be clear, it should be which part of the bond market we're talking, though, right, Jordan? So you talk about AAA, you talk about high yields. What segment?
Look, I have no problem with a intermediate IG portfolio. 5 to 7 year investment grade. I love that. Um, in the PA, now the 401k you can't do, but the PA, I think buying cash twos and then selling puts on names you like, that actually is interesting to me. I mean, vols are still relatively elevated, especially you go out 3 to 6 months, and therefore, I mean, if you're starting with a 3.25% yield, which by the way is state tax free, so in California, kind of like that, or New York. Um, and you're taking a rather fancy premium for some of these names here. So that's probably the strategy I'd employ over here. Of course, but remind you, you sell the puts equal to the cash you have. So if you get put, you have the cash to go buy the stocks you want to own. I would not be doing it on a levered basis. That'd be more challenging.
Yeah, and I wanted to make that distinction because I would not personally be comfortable with anything with high credit risk because I think personally spreads are probably still due to blow out in a big way. There's going to be an opportunity to play spread narrowing, but you have to have a widening in a really hard way first that's sustained for some period of time. But
that is a charting notion. As a U Chicago MBA, we think chartists shall be burned at the stake. Notwithstanding that, I learned to appreciate charting as a way to understand where people own the market. Back to humans and lemmings and society. People like to, if they buy something, it goes down. If it gets back to their, cost level, so they can get out even, they'll do that. Which is why you see, charts tend to retrace to gaps and things like that. Um, that's a look. We had a big pullback. 20 odd percent. Um, that's cheapening. Now, I would argue that 4,800 was the wrong price. So even down 20 is not great. PEs are still high. What we haven't seen yet. What we haven't seen is the E. I don't see how we get a curve this inverted and not have earnings come down. And I can't circle that square or square that circle, whichever way it goes. I mean, something's wrong over here. You can't have earnings continuing to grow with the curve this inverted. One of these two numbers is wrong. And so as far as charting goes, I mean, there'll be guys who say that how X number of bear market rallies were 50%. They'll point to that. I mean, chartists always have something they can point to go prove themselves right, which is why I don't get hung up on it too often.
And I will say real quick, it's also about the sample size, right? I mean, if you're talking about a 100% track record with 4 times in history, okay, that's great, but that could also be randomness.
Oh, I think you're stumbling over the truth here. That the millennials are all getting jobs, and when they get those jobs, they say X% of my money goes into my 401k, and they might have the Robinhood accounts, but the bigger account is the 401k, and they're putting X dollars in there every single month. And I can guarantee you it's going 75% to SPOOs and 25% to a 5 to 7 year IG fund. And that's it. See this constant flow of buying that's price insensitive. That's just coming from the demographic of millennials entering their prime working age. Mike Green's written about this a lot. He's the expert on all this stuff, and they're going to buy index money, and that's it. So in some sense, you're absolutely right. There's a flow of money that keeps on going on in from millennials, and they're probably happier now.
No, I appreciate it, John. So I think that's a good place to end the space. We're a little bit over here. Again, everybody make sure you follow Harley. Any final parting words? Harley, maybe as far as Simplify, just give you an opportunity to talk about Simplify.
I would urge all of you to look at our products. We have some, I can't say tickers, I get in trouble for that, but there's 3 or 4 products that are really interesting. And what's most interesting about Simplify is we have an ISDA. We trade professional products and bring them to retail to civilians. Okay, it's things you could trade on your Fidelity account on the screen. It's risk profiles that cannot be created anywhere else. It's the kind of stuff that hedge fund professionals use. And we were able to do this because of a change in regulations a few years ago. It's why I came out of retirement to join the company. It's why Mike Green came on board. Our risk manager was the head guy at Convexity Capital. An incredible team of people and incredible products that cannot be duplicated elsewhere. And I'd urge you to go and take a look at them and call us up.
Thank you, everyone, for joining. I'll Tukrium, and everybody enjoy the rest of your day. Thank you, Harley. I do appreciate it.
Thank you, man. Have a good day.